All right, so today we'll be considering trading market structure with confidence. Trading market structure with confidence. We'll be looking at that today. Let's share my screen and get us started. All right, so quick way, just a quick review. We'll be doing some examples today, maybe use GU, EA or something, but just a review of the market structure. We're looking for conditions where price is trending. And if we come across a range, there's also a way to trade it. What today we'll be looking at when price trends. So traditionally, price moves in waves. We have push to the upside, pullbacks, and then continuation. Right. We anticipate that when price makes the first move 0 to 1, 2, for an upward trend should not go below 0.0, and then 0.3 should be higher than 0.1. Of course, we don't expect 4 to come below 0.2. It could come this close. It could come almost, in fact, equal to 0.2, but not lower, right? And again, for the uptrend to be sustained, we expect 0.5 to go beyond 0.3. The same is true for a down trend, right? So when price moves from 0.5 and then goes below 0.4, we say we're in a downtrend, or rather the uptrend has been broken. We would anticipate a downtrend. For that case, we expect B to be below 0.0 and above point A, and then we expect a lower leg, going downwards. Some might see this as a head and shoulder, or whatever pattern we want to call it, but this is a downtrend. So I'll be going down straight to GU now, and we'll look at this in the chart. This is a pretty straightforward chart. The only indicators I have, I can call them up so you could see on my chart. I have the daily high-low indicator, which are these dash horizontal lines. It basically tells me yesterday high and low. I have the Asian range, these thick dash lines here delineate Asian range, right? I like seeing them on my chart. I have a simple exponential moving average set to 13. I use that sometimes just to gauge entry. And of course, those are the basic things. Now let's look at price, and let's start from, let's say, the 18th of June, right? You clearly see from the 18th of June, price doing something like this: a push back up, a drop lower, a push back up, a drop lower, a push back up, a drop lower. Then this high was violated, and then we are now in an uptrend. But how do we, trade this? How do we structure this in our mind so it becomes, something that has some form of order? So when we're trending downwards, we mark out the last bullish candle before the new low. In this case, I'm doing this on 1 hour. This can be done on 4 hours daily, 15 minutes, 30 minutes, any time frame to be precise. So this was the last bullish candle, right? Responsible for this low. If price breaks above this bullish candle, we'll assume that this trend has been truncated and we are going long. However, price push never really got to that point. So it basically gave us this and this, right? Then price dropped lower. This is the last bullish candle before the drop. You notice that this candle that looks like a doji is an inside bar. It's inside the body of this larger bullish candle. So I want to use the larger bullish candle as my point of reference. Notice how price melted away again from there. We're still in a downtrend, basically. Here again, the last bullish candle before that drop. Again, drop to the downside. Price pushed up, never closed above our box, and dropped even lower. At that point, you notice this week, coming below the lowest candle of the previous day. So this bullish candle here becomes our candle of reference responsible for that low. Notice at this point that we have a break in structure. So basically, what we have now is something like this, and then a break. This has broken this point. We are now bullish, right? If you trade breakout, once this candle broke and closed above, you simply take your buy. Your stop loss is below. This could possibly, just a moment, please. Let's make this blue. Right, this could possibly have given you a 2R, meaning if you had risked 1%, you could have made 2% from this move simply by knowing that structure has been broken and that you are now bullish. And we're looking at just the 1R. Now, once you got that breaking structure, you are no longer interested in the bullish candle. So in the downtrend, the bullish candles are your friend. In an uptrend, the bearish candles will become your friend. So what am I doing now? I'll start marking out the bearish candle. So here's the bearish candle responsible for that push to the upside. Then we have this bearish candle responsible for the other push. So I have this bearish candle here responsible for this push to the upside, right? Typically, I trade from the close of Asia session, so that will be from between 6 or 7 Nigerian time, or UTC +1, depending on where you are upon the face of the earth. So here I have a candle that looks like a bearish candle. When in doubt, I use Oanda on trading view to determine if this is a bearish candle or not. But let's just use what we have on our chart for the purpose of this explanation. So here we have this looks like a bearish candle, and then we get a break in structure. That means if I'm to trade Asia, I should be selling, right? But I don't trade Asia. For that case, this bullish candle will be my next structure. Price traded back into it and then dropped. If I don't use this candle here, this doji-like candle, as my bearish candle before the push up, this would have been my bearish candle before the push up, and price needs to close beneath it for me to turn bearish. But that didn't happen. So this would have been a good day for the guys in the mentorship or fostering program. You understand this? It took out Asian low, and boom, we're in for a buy. This would have given us another 3-4R or thereabout. But let's leave this out and assume that you don't have the extra knowledge of going to Oanda to confirm, because some brokers feed this might still be a bullish candle and not a bearish one. And for that reason, we might not have been considering this, and this point would have been our entry. But let's say this was actually a bearish candle. So we are bearish. This is the bullish candle before the drop, and this is the next bullish candle before the drop. Remember what we're doing here. We basically have price went up, then price broke to the downside, and then now we are selling. For us to buy, price needs to break this level, then we are now buyers, and that happened here. So basically, we could have entered our trade and then taken the buy, right? So let's put some form of rules here now. So we have some order. I'm not considering trades in the Asia session. I assume the Asia session to be consolidation moments and pullbacks. So we'll consider them. We'll start considering the trades from after the Asia session. All right, so basically we're buyers, and then we came into this day. This was a bullish bearish candle responsible for that high. Price broke it at this level. So in Asia, we would have been looking for, in New York or London, I beg your pardon, we would be looking for reasons to sell. Boom, price went against us and then gave us a breaker. We will now be buyers. So if you were hoping to sell when price came back to this other to this zone for you to sell, price broke it and then you became a buyer. Simple as that. And now you begin to monitor the bearish candles. So here is a bearish candle responsible for that high, and this is the bearish candle responsible for that high. You continue to look for buy opportunities. Again, if you're part of Simply Pips, we basically tell you what time of the day is prime for you to take your entries. We'll have what we call Q zones. You shouldn't be trading towards the end of basically after the end of London, first 2 hours of remainder hours of New York, we're out of the market, right? So basically here you're waiting for all these zones here, you're basically looking for buy opportunities, right? And then boom, price broke to the downside. Now we are bearish, right? We're no longer bullish, but bearish. So from then onward, you're looking for sell opportunities, right? You're basically looking for sell opportunities. So if you're looking for sell opportunities, you're looking for the bullish candle. So this is the bullish candle responsible for this drop to the downside, right? Price needs to break this level for you to become bullish, right? This was the low that was created. Then we had another bullish candle responsible for this low, right? So we're marking up this bullish candle, right, responsible for that low, right? And at that point, we're looking for opportunities to sell. Price broke above, will become buyers, but then we're in the Asia session. We need price to come above. Price didn't, price came lower, so we'll become sellers, right? And you continue that way. You have this all the way to that point, and you're sellers, and you're sellers. The bullish candle responds for the low. The bullish candle responds for the low. You have this point here, right? So when price came back here, you'll be looking for reasons to sell. Price broke above, you'll be looking for reasons to buy, because now you have a breaking structure. But price came back, so you lost that trade, and price came back and closed beneath. Now you're no longer a buyer, you're simply a seller. And then you sell downwards. You sell downwards, right? And you sell. Notice how price respected this order block. Order block, bullish candle, response for that low. Price traded back into it and then dropped, right? You're looking for the bullish candles responsible for the low. This is the bullish candle here, responsible for this low, and price consolidated, never really got back to that point. Then we had a new low created here. So this is the bullish candle responsible for this new low. Then we had a bullish candle responsible for that low. You mark this up again, bullish candle responsible for this low. Price breaks through it, and that's your entry trade at the retest. You have an entry, so you basically could have had a trade like this. You should have given you 1:2, 1:3. And again, if you're a breakout trader, you would have entered at the close of this, and that again would have given you 1:2, which would have possibly 2%, 4%, or 1%, depending on how much you risk on your account. Now we are bullish. Well, bullish will begin to mark up the bearish candle. Bearish candle response for that high. Then we'll have the bearish candle here. Sorry. We'll have this bearish candle responsible for the new high. Price needs to break below this for us to be bearish. This was the high so created. We need a new high to be able to get a new bearish candle. And so this is the bearish candle responsible for this new high. Price needs to break this candle for us to be bearish. We have our high here right now. Sorry. We have our high here right now. Right, so here we have a bearish candle responsible for this high. So marking up that bearish candle responsible for the new high. And then we'll have this bearish candle responsible for this high. Price breaks to the downside, it means we are bearish. If you're a breakout trader, you enter at this point and then you are selling. Stop loss is above structure there. This gave you 2%, 3%. Some of my students decide to give 2% as thank you and 3% as thank you, Lord. So that's why you notice that on the fib. Again, this is the bullish candle responsible for this low. This is at the lowest point we have on the chart right now. Price needs to go below that lowest point for us to have for us to begin to consider a new bullish candle, right? So everything here, we're basically looking for sells until price breaks above this bullish candles. That is when we begin to buy. Until price does that, we're looking for sells. Very wonderful sell trade here. For those of you who understand, I think one of the videos last week, high probability low risk trade, would have had an entry here. That would have given us like 1%, then push back and give us another entry, and then we'll resume our sell. But let's move on. We had a new low here, therefore we're going to be marking up this bullish candle responsible for that new low. Price needs to break above it for us to be bullish, and we need to have a new low for us to have a new for us to consider a new bullish candle. And we got the new low here, and this was the last bullish candle responsible for that low. So we would be looking for sell opportunities around here. We didn't get another low. Once price broke above this bullish candle on this day, and at that exact point we became buyers. So today on GU, that is the trade, and this would have given us 2% before 2 hours before the market closed, on its way to 3%. You see how easy it is to, without so much trouble, just monitor the market on 1 hour and basically just scalp, or depending on what you want to do, you could do this on 1 minute, you could do this on 5 minutes, you could do this on practically any time frame of your choice, following price and delivering. You know, this thing is what we do day in, day out, and I see no reason why any of you out there cannot repeat this. Just pick up any pair of your choice and try this out. Obviously, the lower the time frame, the more noise you meet, the more erratic this will look like. You could do this on 30 minutes, 15 minutes. We have an entry on 15 minutes we call VTB, and that we use, break the bank candle. We use that on 15 minutes to gauge our entry, and it's basically using this same concept. I could go down to 15 minutes and see, so in 15 minutes you have more trades, but you also have fake outs. But that notwithstanding, one of the things we learn is that we are ready to take the losses because we know the winners will basically come. All right, so let's start from here and do this just on 15 minutes to clear this up, and then we'll call it a wrap for today. If you are watching this and you are not subscribed to the channel, subscribe. Support the channel by subscribing and hitting the like button. This will help YouTube algorithm to suggest this video to others, right? So let's start. Even though I say we don't trade the Asian session, for the purpose of explanation here, I'm going to mark up the Asian session as we move, so you see how we could have gotten in. You could do this and get an Excel sheet, tally your losers versus your winners, and see how often you would have won and what this could have done to your account. So let's start off. Let's assume that we're basically bearish, and we became bearish from here. So that was the bullish candle responsible for this drop. And then we had this bullish candle here responsible for that drop. So we'll keep being sellers. Once price broke beneath it, we're sellers. When price broke beneath it, we're sellers. The only time we'll consider buying is if price breaks above this last bullish candle. When price breaks above it, like here, we would be buyers, right? We would be buyers at that point. And the bearish candle responsible for the high. Remember, in a downtrend, when we're going downwards, we consider the bullish candles. And when we're going upwards, we consider the bearish candle. So when price broke above, our focus is now on this bearish candle here. our focus is basically on the bearish candle. And when price came back and broke beneath it, we're basically sellers. So when we came in at prime time, 6-7 Frankfurt or London session, we knew we're basically sellers off the 15 minutes, and we would have had our entry there, stop loss above the OB there. So the stop loss will be above, and you're entering anywhere there. This again would have given us 2 or 3%. 3 are basically 3 times our risk. Again, let's continue. So this was the bullish, this was the bearish candle responsible for that high. When price broke it to the downside, if you are a breakout trader, you're basically selling from this point. If you are a retest trader, break and retest, then you wait for the retest, and then you're selling basically. All right, so let's jump all these points and come back here. Let's jump forward a little. This is the bullish candle response for that drop. And there we are. Then we'll have this bullish candle here. Right, this bullish candle here, responsible for this wick and the pin hammer there. All right, so when price broke above, we became buyers. So meaning we would have still been looking for sells somewhere here if price came below, but price never did. Price pushed upwards, we would have been buyers. PTMM traders will see this as a W, for a buy. And line chart, let's make this yep, right, so we'll have a clean W there for a buy. But basically once this broke above, we would have been buyers. Our stop loss will be beneath, and there we are. This gave us well over 3%. Right, 3% is somewhere here, and we basically would have made 4% from this, depending on your trade plan. Again, but let's mark this up as it goes. So when price broke this level, we became buyers, and then we begin to consider the bearish candles from them forward. So here is the bearish candle response for that high, and then we'll have this bearish candle, which is weak response for that high. Notice how price came, pierced through the wick, never broke it, went back, didn't create a new high. We have a high here. Price never really broke above it. Then we had this bearish candle responsible for that high. We'll mark up this bearish candle. We're still bullish here, guys. Price pushed up. I usually don't like this type of candles, but let's mark it anyway. So here again, price bounced and kept going. Bearish candle responsible for the high. Bearish candle responsible for the high. Bearish candle responsible for the new high. That's the candle of reference for the remainder of the day. That was the highest point on our chart as at now. When price broke to the downside, we were sellers. Again, we don't sell in Asia, but no problem. We assume this is just consolidation in Asia. But let's say you weren't sure. Now that price has broken below, you begin to take the bullish candles. This is the bullish candle response for that low. And then you have this bullish candle responsible for this low, which happens to be the lowest point in Asia. So price needs to close above this bullish candle for us to be buyers. And there you have the close above, and then you will have initiated your buy. Right, again, in this day, here you are. It gave you a 2 or 3% again. Powerful concept, guys. Powerful concept. So there again, we are buyers. Now begin to consider the bearish candle. So this is the bearish candle responsible for this high. Right, price needs to come back and break beneath this bearish candle for us to be buyers, except a new high is created. At that point, this was the high that was created. Once we created a new high, we watch out for the last bearish candle responsible for that new high, which happens to be this. Then we had another new high there, and this is the last bearish candle responsible for that new high. Price basically closed beneath it. Breakout traders will initiate a sell straight up. Retest traders will wait for the retest, and then we are bearish. Ladies and gentlemen, I think I've been able to prove to us that without doing so much, without hitting our heads on the wall, we could basically trade you know, price action and do well. We're bearish here. This is a bullish candle response for the low. This is the next bullish candle response for this low. Notice how price never closed above it. So when price broke beneath here in London, we would have been Frankfurt, to be precise, would have been selling. It pushed back. It needs to break above for us to buy. And as small as this was, it would have given us 3R. Once it broke beneath, we enter at the breakout. If you're a breakout trader, it would have given you 3%. And if you're a retest trader, there is a retest on that week. Again, this would have given you 3-4% of your account. So you're out, you're waiting to see what price will do next. Price never really gave you a new low and didn't break above. It came back here and then it melted. You begin to look for the new lows so created. And you had a new low here. And this becomes the bullish candle responsible for that. And then you have another bullish candle response for the low. You're basically sellers. You continue to sell until this level is broken. And it wasn't broken, ladies and gentlemen. You are still a seller all throughout Asia. You are selling, right? You're selling. You finally got a new low here, right? This was a low, a global low. Yesterday's low is this dashed line. This came below yesterday's low. What was the bullish candle responsible for that low? It happens to be this. Price needs to break this level, which it did here. And once that happened, boom, we are buyers, ladies and gentlemen. So your stop loss is here and you're buying from there. This gave you 2%, 3%, and then you keep moving on to where you get to. We got to where we painted before. So I hope this will help some traders. Take time over the weekend, mark up the charts, play around with them, drop your comments and your charts. I need you to join our Telegram group. Just look for Simply Pips. Right, Simply Pips _ Pips. Join us, and I think I'll drop the link to the Telegram group in the description. After now, click on it and come join us and see what we do. What we do with the markets, right? We basically try to train people to become prop traders because we believe if you have $1,000 of your own, and even if you make 50% in a month, and I tell you the truth, 50% is a heavy amount. Anybody who has traded for a while knows that 50% is not an easy feat, and it's not sustainable, something you could do every month. I don't care what any other person says online. 50% isn't something you could do every single month. So, well, let's say you make 50% in a month. That would just be 500. It depends on where you are on the face of the earth. But I know if you're a progressive thinking person, 500 won't pay your bills consistently, except you don't want to grow. So we usually would advise our friends and people in our Telegram group to understand the skill and trade for prop firms. So let's say you're trading for a prop firm and you have access to $50,000. I particularly like FTMO. And so let's say you're able to trade for them and you did 1/5 of your performance. You're only able to make 10% in a month. That means you would have made $5,000. A company like FTMO will give you 70% of this 5,000. That sums up to be like 3.5. This is head and shoulders above the 5,000 you would have done and risking 50% of your account, right? This is prop trading firms are practically a blessing for retail traders. Give us an opportunity to do well. And I'll quickly show you our Telegram group and what people have been doing, right? Guys have basically been crushing. We have a member recently who just today, July the 9th, is going to get his first split from FTMO, 6%. And people keep clearing this. Every time this guy made it in 3 days, right? This is another prop firm, my Forex funds, people clearing FTMO 2 days, right? Notice the equity call. people clearing FTMO in 10 days. He did almost twice the required target. 4 days, did the required target, right? Powerful results. This has cleared the first challenge for my Forex funds. Powerful results, day in, day out. We teach you how to handle drawdowns with our asymmetric compounding risk reward ratio. How do you come out from an 8%, 7% drawdown to crush your targets? Those are some of the things you get to learn. 7 days dusted. So guys, join Simply Peeps, and then let's talk better. Thank you for watching the video. Remember to subscribe, like, and share this video. Bye-bye.